Okay, in this presentation we're going to review zero coupon bonds and how we calculate their interest and how we'd record them on our financial statements. So let's look here at a cash flow diagram on a zero coupon bond. It has a face value here, or a maturity value, and in this case I have it at $100,000. And that would be out in the future here. This is a 5-year bond, so 5 years in the future the bondholder would receive $100,000 if they held it to its maturity date here. There's no stated rate of interest on the bond, and there's no semi-annual interest payments on that bond. What we do is we discount this face value or maturity value back using the market rate of interest to determine its present value or its purchase price here, discounted purchase price, and that would be at the beginning of the bond here. Now, in this case, I used the market rate of interest of 8%, and it had a 5-year term here, and there were no payments on it, but it had a $100,000 face value. And then using this Excel function here, I determine its present value or its purchase price to be $68,060. So taking the difference between the $100,000 and the $68,060, we get a discounted amount here of $31,940. So the difference here between that purchase price and the amount received when selling the bond is our profit or an expense here that we have to allocate on that bond. All right, let's amortize the interest received or payable on this zero coupon bond. And this assumes that we held it to its maturity value of $100,000 and we purchased it here at its present value of $68,060. So going down here to our amortization schedule, we start out here with a book value of $68,060. That's when it was issued here on the beginning of year 1. And then for the interest that we recognize, or interest expense for that first year, we take the market rate of interest, the beginning book value here, and in this case it was 8%, and we take it times this book value and we determine the interest expense to be $5,444. So that would be the amount that we amortize on this discount to this bond. So we would take and we would add this amortization amount here of $5,444 to the book value, and then we'd have a new carrying value here for the beginning of the second year. And then we just repeat this process here where we take the market rate of interest times the beginning book value here, and then we get the interest expense that we recognize for that year. And then we just continue that on here through this amortization schedule. So at the end of the 5th year in this case, its maturity value and its a book value here would be equal at $100,000. And you can see here that our interest expense would be $31,940 over that 5-year period that we'd recognize, and then that bond discount here would be amortized down to a 0 value here. All right, let's record this zero coupon bonds receivable on our balance sheet. Now I have it laid out in T-account form here, where I got the asset account shown over here on the balance sheet, and then the interest revenue that we recognize on that bond as part of net income on the income statement shown here. So let's look at it in terms of a bonds receivable. We go out here and we purchase a $100,000 face value bond that's going to mature in 5 years. And we would debit the bonds receivable for that amount. Then we go up and we pay actually $68,060 for it. So we would reduce our cash account by that $68,060. So we need a balancing entry here between the cash account and this bonds receivable account. And here's where we use a discount to this bonds receivable. It's a contra account, or it reduces our bonds receivable account. And we would credit that for $31,940. So that credit here of $31,940 plus the credit here to cash is $68,060 balances with the $100,000 debit balance here to bonds receivable. So this discount the bonds receivable, we amortize that down to a 0 balance here at the end of the 5th year. Now the discount amounts here are based on the carrying value of the bond at the beginning of the year times the market rate of interest for that bond here. So these debit amounts here would be recognized as interest revenue, or credits to interest revenue by that interest that we recognize on that bond each year. So at the end of the 5th year, we've recognized $31,940 worth of interest revenue. Now that's based on the market rate of interest times the bond's carrying value each year. So if we go back here and look at the relationship between this bonds receivable and this discount to bonds receivable, we can look over here and we can see that this discount to bonds receivable, as we amortize it down to a zero balance here, we actually increase the bonds receivable account by that amortized amount each year. So we start out here with a bonds receivable of $68,060, and then when it becomes mature in the 5th year, into the 5th year, it has a $100,000 carrying value, which matches the carrying value matches the face value of that bond. So if we go back here and we look at the maturity, when that bond's mature, we would reduce our bonds receivable by $100,000, and we would increase our cash account for $100,000. So that's where we received our payment on that bond here. So just going back here and looking at this discount to bonds receivable, that's the interest revenue that we recognize each year on that bond, and that would be recorded over here in your interest revenue account. So that's just a summary of how we would record zero coupon bonds receivable on our balance sheet and on our income statement.